Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending January 11th, 2019. Well, we've seen a lot of really interesting stats across the wires here for the past 3 or 4 months, primarily in Q4. October started it off in Q4 as the worst month since 2008. I mean, the entire month it was down a little over 7.2%. For the S&P. The Dow was down over 5. The Nasdaq was down almost in correction territory just for the month of October. It was down about 9%. And then also we saw October being the worst month since 2008. Not to be outdone, December said, well, we're going to be worse than that. In fact, December, it was the worst month since 1939. And depending on how you count the records, you could probably argue it was the worst month ever for the markets. And then as we go into January, obviously this big, huge downswell, everybody was selling. A lot of people got short the markets. And then going into January, we've seen some more records broken. I think we saw on the advanced decline line, we set a record as the largest point swing in the Dow, over 4,300 points in this advanced decline line. And the prior record was made in December of 2008. So we've set this huge record here in the advanced decline line. And just looking at some of the stats, anytime we've had a swing, and this is all within a 10-day period, by the way. Anytime we've had a swing of more than 3,000 points in a 10-day period, we've seen the S&P on the advanced decline line over the next 12 months move up 9.8%. Now, it's only happened 11 times, so I guess you could probably argue that's not enough data points, but we've just had some huge swings in the market. And, one of the things in one of the quotes I saw, which I've always really liked, it said that investing is about figuring out the unexpected, since the expected is already priced into the market. Now, we've got a lot of bad news already priced into the market right now. We've seen the Feds do an about face on their monetary policy, on their forward guidance. They pretty much shifted to a data-dependent mode. The bond market is forecasting, I think, maybe one rate hike, but that's even iffy, you know. Power Ranger Powell came on and said at the beginning of the year that we're going to be data dependent, and he kind of walked back his statement of autopilot on the quantitative tightening to the tune of 50 billion a month. I believe that serves as more risk for the market personally than the forward interest rate hike. Now, the dot plot says 2. We'll see what they say. We got a Fed meeting coming up the end of January. And then we've got another one coming up in March. February, we skip a Fed meeting. This next week, we kick off earnings, big time, mostly for the banks. We've got on Tuesday, we're going to see JP Morgan and Wells Fargo, and then a regional with First Republic. Wednesday, we get Bank of America, Goldman Sachs, PNC, U.S. Bank Corp, and Bank of New York. And then Thursday, we get, if that's not enough, we get Morgan Stanley, KeyCorp, BB&T, and American Express. And then finally, we round out the financial community with State Street and SunTrust Bank. So we've got a ton of earnings next week regarding the financial community. As our members know, I came out recommending that they pick up some banks earlier this year, or late last year, with that big downswell. I liked JP Morgan, Bank of America. We've already made some money in those trades for our members that took the trade. I just think it was overdone last year. But we've got that coming up this week. The other thing is the issues that were present in Q4 of last year are still present in the markets today. The U.S.-China trade talks seem to be progressing nicely. We've got Lighthouser and Hugh, or Hu, however you pronounce his name, coming in from China. He's their senior negotiator, along with Lighthouser. They're meeting the end of this month. I think Xi and Trump want to do a deal. Now, the line in the sand was originally cast as 2 March. I can see them not boiling the ocean, but coming up with some kind of formal agreement enough for Trump to come out and tweet that they've extended this deadline. They seem to be making progress. And I think we'll see the Dow move up another 1,000 points, 2,000 points on that news. That coupled with the Feds and their mea culpa, and Powell just not really being a great communicator. He's a smart guy, but he's just not really good with his words, like a 5-year-old kid, I guess, or a very expensive exotic parrot. So we're going to see. Should that come to be, then we're going to see the markets move up. We also have the Fed monetary policy, but like Powell has said, they're going to kind of be data dependent. So that means all the CPI numbers, any inflationary economic data that hits the wires is going to be closely watched. Markets believe inflation is benign right now. Power Ranger Powell believes that the inflation is relatively flat. So we're going to see how this plays itself out. Even the CPI numbers that came in this past week were flat. So the only thing that can affect it is wage growth is just going to pop up. But if we get some productivity increases as well, that tends to suppress inflationary tendencies. We've also got the political dissonance occurring in the U.S. here with the Republicans and the Dems. They're just fighting like crazy, like 5-year-old kids. Neither side wants to budge. And all they got to do, both sides, is just take a step forward a little bit. I think the Democrats are being a little bit overly melodramatic, but that's kind of how liberals are. Conservatives tend to be a little bit more hard nosed. But I think if both sides bend a little bit, they'll probably get a deal that'll kind of help the markets a little bit. We've also got growth issues across Europe. I mean, the ECB and Super Mario Draghi, he's got these growth issues. He's already talked about quantitative tightening. To be honest, with inflation going nowhere there and their GDP numbers falling, and Germany, their best economy in Europe, has already had a contraction in Q3 in GDP. I don't know how Powell or Draghi can do what he's saying he's going to do. So Europe is having some flatline issues right now. So we've got to watch that really closely. And then finally, the issue that I think is going to be a really big one is the U.S. Corporate bond market. They've taken on a lot of debt with this free money for the past decade. And of all the investment grade debt, about 60% is estimated to be triple B, which is the bottom of the ladder for investment grade. Now, I spent a lot of time with our members in our option masters and on a lot of our sessions talking about why debt is so damn important and why the credit spreads and the yields that are floating around out there across the duration curve of bills, notes, and bonds are just so important to follow. Even if you don't trade them, you better damn well understand them if you're buying equities or going short equities, because they kind of drive the equity world. So we're going to spend more time on that with our members, but it's something that's given us clues to early warnings of interest rates going down when all logic would say interest rates were going up. Same thing with the US dollar. We've also looked at correlations between various markets, and those have really given us some good trades in Q4 as we've had this bounce. Now, what you see on the screen here is a Bollinger Band, but I've laid 3 Bollinger Bands on top of each other. So you've got a 1 standard deviation away from the mean, which is a 20 EMA, essentially the yellow line. And then you've got the blue line, which is a 1 standard dev, the purple line 2, and the red line 3 standard devs from the mean. You can see that every time so far since we've had these problems, right? I mean, you could see just how tight volatility was leading up to the problem as we got into early October. Once, excuse me, once we hit early October, when we've moved above the mean and we got right around a 1 standard just 1 standard deviation, we didn't last more. This is a daily chart. We didn't last more than a day or so, and then we came right back in. Same thing right here. Now you can see we're fighting it right here. So the big question mark I have is, are we going to be able to get enough velocity to break out and move up higher, or are we going to come back and test the median of this Bollinger Band? Okay, which puts us right at about 25.20. And all of my charts, my pivot highs and pivot lows, kind of show the 2520 as a value area within a pivot high and pivot low on a daily chart. So we've got to be prepared for a little bit of a retest here, and I think it would be good. This is my key pivot low right here if I were to just draw it on this chart, which is around 2450. If this can hold up and we can pull back and then we can start making some new pivot highs, it'll allow us to move back up higher here. Now, a lot's got to happen for this to happen, okay? We need to see progress the end of this month, number one, in the China trade tiff with the U.S. Number two, we need to get earnings coming out because they're going to kick off, as I said, next week, primarily with the banks. We got a ton of banks. We need to see them come in. They're going to have good earnings for Q4, but everybody's going to be paying attention to forward guidance. The bar has been dramatically lowered, but some analysts feel that it hadn't been lowered enough. We're going to know very soon. If the bar is still a little bit too high and we break this level here, then we're going to have what pretty much a lot of analysts have been talking about, which is a retest that we made in late December of this past year. And that's kind of the way I would see it as well. All right. So I'm not expecting too much upside here near term. We've had a great run off of this little bit of a pullback right here. And I would expect at least a little bit of a pullback here, catch our balance, and then let's just see. Remember, we got the Feds. There is almost a 3% chance the Feds are going to hike the rate the end of this month, and there's no more than about a 15% chance they're going to hike the rates in March. The bond market is forecasting almost no rate hikes for the year. So that's a little bit about where I see everything on this chart. Using these three Bollinger Band levels, the standard Bollinger Band is 2 standard deviation, but I put 1 and I put 3 in there. So it kind of gives me a little bit of an accordion effect. Gives me a good idea of just the strength of the move up and the strength of the move down. Now, if I were to also just go over and show you another chart, let me just get that on the screen here because I got about 12 monitors floating on my desktop right now. And let's just go out. This is a daily chart, but I'm going to go all the way back to when the secular bull market started here. And let me just squeeze it all the way back. All right. This right here was the 55% downdraft that we had in 07 and 08, as you can see down here like this, right? And then we just came down. And then we started a long slog higher, okay? Really high slog. You can see the correlation of this about 0.98. So it's a fairly, when I step back like that, it shows you a fairly tight range. Now, I've also got in here, as you can see, I've got some of the key downdrafts that we've had in the market as we've moved up, right? I've got to kind of bounce it back out a little bit, and it's off just a little bit because I've bounced this thing around. But you can see we've had this was a little bit of a pullback from some of the highs that we've had before. And we had in basically 2011, we had a pretty good little pullback back in this area right here, okay? And it was about, I want to say, it was about almost, it wasn't quite that much, but it was a little, not quite 20%. And then we had a pullback here that occurred that took us down about 13%, maybe a little bit more. And then you can see the pullback here. And this pullback goes and measures to this upsloping trend line, all right? You can see we've been in this regression channel, and every time we've broken out of this regression channel to the downside, the first time we did it was back in 2016, prior to the Brexit vote. We moved right back in again. Same thing here. We broke out of the regression channel, and then we've broken back in again. Okay, and then this green line is just a simple upsloping trend line. That's all it is from the lows here. And we've come down and we've touched this trend line numerous times. And you can see the pullbacks that we've had here. So right now we're back inside this regression channel, and I'm using this, and primarily this upsloping trend line that has, kind of defined this secular bull market since 2009. And I'm going to watch this very closely. Do I think we're going to get a little bit of a pullback? Yes, I do. I think we're going to get a nice little pullback here. I don't think it's going to take out the December lows, but you know what I think doesn't really matter. It's how the markets are going to react, where price action is going to go. Okay. But if you look at this and you really follow the markets, you can see that we are just floating up, and we're due for a little bit of a pullback here. Now, let me just take us down to another chart here that let me just get my screen over here, and I'm going to take us back to the E-minis, but another chart right here. This is the daily chart, and I've got pivot highs and pivot lows, and I got what's called a market map that's painted on here. And you could see, if I zoom out here, you can see each of these market maps. This is a weekly chart, so each of these market maps run about 90 weeks in duration. And you can see it measures a value area during that market map time frame. In some cases, there's 2 value areas. Other cases, there's 1. You can see this huge value area that really kicked off in March of 2017. And it puts the value area right around 2734, which also happens to be one of our major overhead resistance. Okay. And if I zoom in, there is no divergences in this chart. That to me suggests that we're going to get a little bit of a downdraft here and probably challenge this low. You can see to our upslope and trend line here, which is the same one I showed you on the previous chart. We actually came down about 21.39% in the futures market. We didn't do that in the cash market in the SPX, but the E-mini futures we did. And you can see this huge move off the lows here. And if I take it back down a little bit closer, and let's go into a daily chart, you can see again these market maps, which really we've kind of been in this tight range here. You can see each of these 3 market maps measures about 1/4 of time, okay? A little bit more than a quarter of time here. And you can see right here, we've got 2 value areas. We got one at almost 2,500. We've got another one here sitting at 2,640. All right, so if I were to blow this up and then on top of that put in our pivots, right? You can see here off the 2018 low and then the 2018 close, we're in the green for the year, but we've exceeded our pivot high here. So this suggests, and then there's overhead resistance here at 2635. So we're going to encounter a lot of resistance here. I would not be surprised to see us pull back a little bit. I want to see if we can hold the 2018 close, which would keep us in the green for the year, which is just slightly north of 2,500. If we can do that, then I think we can get some lift and we can move higher. Okay. And of course, if we look at the Dow the NASDAQ on the daily chart, and we put in our market maps, you can see there's overhead resistance here too at around 68.20 roughly. You can see the 2018 close. So we're in the green for the year. And we're coming to our pivot high here in NASDAQ. Again, there's no divergences here. So this suggests to me we're going to pull back a little bit before we can go higher or much higher. All right. Irrational exuberance can take us up a little bit higher, but I would be more of a seller than a buyer. I am still of the bearish bent right now, looking for a little bit in a pullback perspective. Of course, if we look at the Dow futures, you're going to see the same thing. All the charts have set up the same. We've broken out of the pivot high here, this little red bar. You can see way up here is the value area on the Dow at roughly 25,002. We're sitting just under 24,000. Now, the only thing in my mind that's going to get us up to the 25,000 level back into the Dow again is if we clear the hurdle with the China U.S. trade tiff. We've still got the 50 EMA as overhead resistance on all of these. You can see the cross. Until that changes, I'm still of the opinion that we're going to run up into this resistance area and roll back over. And then when we do roll over, because I believe this is going to happen, we need to look at the 2018. This should be 2018 close instead of 2018 open. So let me just change that on there. But when we do roll over, I want to make sure that or at least gauge the price level as we come into the opening for the year. I want to stay in the green for the year. So, it gives us a little bit of flop, but not much. Volatility is still elevated. If we were to come in, well, one other one I'll show you. Let's look at the Russell. This is one of our good trades for the past couple of weeks because we were in a pair trade in the Russell. And you could see here the Russell hard off the lows down here. And you could see off of this 1252, we're now at 1447. You're almost 200 points in the Russell. I mean, just a tremendous blast higher. You can see the Russell is now challenging, the first one to challenge the 50 EMA. You can see it's challenged the 50 EMA here, and it challenged the 50 EMA here. Both times they failed. We're sitting here 3 days at the 50 EMA. If it fails, which I think is a higher probability, I think we could come down here, and then I want to see a little bit of consolidation before we move higher. Okay, so that's a little bit about what I see in all the major indexes in the futures market. If we look at the VIX, it closed the week at 1819. You can see this high point up here. We moved from the red zone into kind of the rose, into the yellow or cautionary zone. We're still elevated, but as I said with volatility, when it spikes like it did October, November, or last January, February, what you've got here is a situation where VIX is going to have a tendency to stay at least in the yellow for 90 to 120 days, the yellow range, which puts us anywhere from 15 to about 22 in the VIX. It's come in a lot, but I think anything, because it's still sensitive, it can move up higher very quickly. If we look at the front month vol term structure, we're just barely in the green. Okay, you can see here that we're 80. The VIX is 86 cents less than the front month vol. Now they've got to equal each other, and it'll wind up right at zero. Once we go into close for the vol futures, the front month vol futures. But right now we're in the green, so that indicates we're in a contango environment, but just barely. And if we look at the back month vol term structure, again, we're in the green here. This measures January and February's volatility futures, and we're not in a backwardation here either. So you can see vol has come out of the market a pretty good deal just recently. So we're going to watch this very closely as we go through earnings. Now, this chart right here really affects VXX. And as I said before, VXX is going away the end of this month. If you're in Thinkorswim, they'll just close the trade down. They'll settle it for you. You'll probably get a few emails, I would imagine, warning you that you've got to shut the trade down. But then you can replace it with VXXB, which is going to trade the same according to Barclays as VXX. The fund manager is going to run it exactly the same. So that's what they're doing. They're just doing that because VXX was a 10-year exchange traded note, which means it had a limited duration life. And they're going to set up VXXB the same way. So that's a little bit about where we are in volatility. If we look at the bond market, you can see it was up slightly, but on this daily chart, look at the bonds. I mean, they were at a low here in October, and then you can see the rush to the bond market in Q4 as the equity market came unglued. Okay, and now we're elevated a pretty good deal. This is going to determine the correlations kind of snap back into a normal correlation, meaning when equities falter, bonds tend to go higher. Driving yields lower. And because the Feds have come out and pretty much done a mea culpa on their rate hikes and being more data dependent. I mean, why hike rates when inflation is flat, right? So that would have a tendency to keep a bid underneath bonds and keep bonds a little bit higher here. So if it can get a little bit higher, I'll be the first to short bonds. I'm looking at that anyway right now, but that's kind of where we're sitting in the bond market. Currency market, you can see the dollar has backed off a little bit, right, from the highs. I mean, we've just taken this down. We're testing this area here, and that would make sense because of the monetary policy of the Feds. Just saying we're going to back it off a bit, and that's kind of where bonds are right now. I mean, the U.S. dollar. The euro obviously is just the opposite, but I'm not a big believer in the euro, guys. I think the euro is going to have some issues this year. So I would be more willing to short the euro up here than go long the euro. Okay. Um, but the yen has also been very strong in times of stress. Look at the yen here, and let me just put it on a different time frame and back it back. Let's go this like this. So look at the yen. I mean, the yen has just been in times of global stress, money goes into the yen. If the global markets slow down or kind of volatility comes back in, then the yen will come back down. The yen tends to be more positively correlated with U.S. bonds. When bonds goes higher, the yen goes higher. The British pound is where we want to play. That's where the action is going to be coming into the Brexit. We've had some lows here. We've had some divergences, which would suggest being long the British pound. You can see we're just north of a value area here. If we break out of this 129, we're going to run up to 130 pretty quickly. Test the 50 EMA. All right, we're already over the 200 EMA. We're already over the 50 EMA. So this would suggest we can go a little bit higher in the British pound. Oil. We've had fun in oil, guys. I know we have members that made 30 grand on some of our oil trades. Up in this area here, we were getting short oil or oil futures, and it just, Katie bar the door. It came down big time. Okay. And you can see here, we're now attempting this run up. We're right at a big value area at 52.37. So this is going to serve as resistance. It's also where the 50 EMA is. Looking at my charts, this would suggest oil is going to go lower. Oil is also a global growth story. Price action tends to be falling. We had a perfect setup for a long trade right here, down at the bottom. We had a great setup for a short trade back up in this area here as we started to roll over. So we're playing oil to both sides. Right now, I'm more neutral oil. I think the near term is probably neutral to slightly down. Any upward move, I had said oil can move up to the mid 50s, but I just don't see it getting much north of that anytime soon. Natural gas, we played that beautifully. When we had this big explosion in natural gas, I got our members into it. Once we broke to the downside, that was a great trade for us. Anytime you get an explosion in a commodity, you've got to really take a serious look at taking the other side of the trade. And there are ETFs now that you can make this play as easily as you can in the commodity market, but the big money's in the commodity market. But you can still do it in the ETFs. And we did a ratio diagonal on the ETF UNG, which worked out nice for us on the downside. I think there's a little bit of upside in nat gas. We had a little bit of a move higher just because of the cold winter blast coming across the U.S. right now. But remember, as we go through the middle of winter, nat gas, the tendency is to come down. So this was just a low-hanging fruit kind of trade for us. If we look at the spread between Brent and WTI, the Saudis are trying to put a lift or a bid in the oil, which is keeping this up a little bit. We traded this spread here to the downside. I mean, this was just a great trade for us. Right now, we're just in a choppy range. I think the tendency of the move will be to go down, but there's no trade in the spread right now between the two of them. Gasoline, well, this was another one that we were talking about shorting back over here, and you could see this wide chop, and then it just gave it all up, more so than oil. I mean, the profit per contract in gasoline was amazing. Now, near term, I think it's going to run out of juice and come back down and just test this area a little bit. We had an entry level right here to the upside, where back over here we had entry levels to the downside. All right, so the energy market has been good for folks that have been following us. Now, the precious metals, everybody knows, or at least if you're following me here, and it's just freebie advice, is just let's go long gold. And we started getting long gold back down in this area down here back in October, November timeframe. Now, obviously, gold moved up, not as much as people thought with a hard move down that we had in Q4 in the equity market, but it's still a hard charger. Now, we've got a huge value area sitting at right at 1,300. I think we're probably going to pull back a little bit. You guys probably recognize the pattern though, right? I mean, you've got this move here, and then you've got one of these kind of things like that, which is kind of a cup and handle kind of thing. And the move north of there is typically around 10%, and then you'll look to set some tight stops. 10% off of this puts us at about 1430, right? Maybe a little bit north of there. But that would mean that we're getting an implosion in the equity markets and they're coming back down again. Even if we don't, I think the dollar's going to be weaker, and that's going to be supportive of a bullish position in gold. So this is something that we've been on since down in this area here. In fact, down in this area here, I was suggesting folks sell puts underneath the gold market, and if you wanted to, you could just do a spread, so you limit your risk to the downside. But either way, it's just been a good trade, especially for those that wanted to go long GLD or gold futures. GDX is another one which is a little bit more, got a little bit of a more juice to it. Um, so trading GDX to the upside, the gold miners, you can see here it is also moved up, just like gold. I, but I would not chase it up here, folks. I would wait for a breakout above these high levels in both gold and all these others. Silver's the other one, guys. I mean, I'm still holding a position in silver, a long position in silver. We were accumulating down in this area down here, just like gold, but it's a cheaper ETF. So you can just buy the ETF and hold on to it. I do believe it is going to reach back up to this former value area around 1650. And possibly move higher, but not without a little bit of a dip. So any dip, I would be a buyer on dip than anything else. Now we got some things cooking in the ag market, in the softs market, and we've got a number of things in the equity market that we're looking at here. So, and for our members, we just put on a trade that's particular for the portfolio margin folks, which is a really good trade that we call the Dragon. And we're running it on what I call the Rolling Thunder strategy. So if you're not a member of our group, I highly encourage you to come in. We're doing well. We had a fun year last year. This year, I think, is going to have even more twists and turns, if you can believe it. And we're just going to play this thing out and have some good runs. Okay. So we've also got some things I'm seeing in emerging markets that could set up very nicely for us. We're already playing emerging markets right now. And I just think there's some other setups that are going to happen once we get through some of these issues here with the China U.S. trade talks. All right, everybody, have a really great weekend. Members, I'll see you this Sunday night for our weekly market watch coming up for the next week. Take care, folks. Ciao now.